to Nirmal, ladies and gentlemen. I'm Hiraldadia. We have with us Lakshmi, Iyer, CIO, Fixed Income and Head Products at Kotak Mahindra Asset Management Company, joining in. Lakshmi, welcome to the show, and always a pleasure to speak to you and get insights from you. Lakshmi, my first question coming to you is, how are you reading the global situation right now with what central banks are doing, with the latest action that we've seen in terms of Bank of England as well?
Hi, Hiral. Thanks a lot for having me over again. At the current juncture, I would say that there is a multiple confluence of central bank activities happening globally in response to multiple stimulus, if I would say, because there is the biggest mammoth force, if I were to call it, the US, and then I call it the Niagara Falls, where there is a relentless rise in inflation, and to combat that, you're seeing a series of rate hikes. And of course, jawboning the markets to believe that there will be more rate hikes, and it's not over yet. So that's one kind of a narrative. And then you have on the other side what we saw yesterday, though Bank of England did say that it is a temporary event to tackle a particular situation. But we are looking at fiscal stimulus, for to be able to pump prime the economy. Given that there are similar kind of concerns, and a mini version of QE with the purchase of bonds. Of course, as I said, it's for a finite period of till about October 14th. And of course, then you have the Eurozone, which is in a much worse off condition, where the inflation is relentlessly rising and the economy is way worse off. So I think that's the confluence of factors in under which we are as a nation existing right now. The good part is that our resilience factor compared to all of these or each of these geographies that I discussed is way better. So while we don't have to be overtly paranoid about what is happening there, but one needs to be extremely mindful, because the repercussions of that into a country like India will definitely be felt. Of course, the degrees that we're talking about can vary, but it is definitely a fluid and a volatile world right now.
Absolutely. So, Lakshmi, when you say yes, we are much more resilient, there is a better shield to India versus other markets right now. What's the sense that you pick up with the action of the RBI, the way they've been managing the rupee, the way the bond markets in India are right now?
So far, if you see, our inflation is lower than the US. Number two is our growth rate is higher than the US. But number three is the fact is that our real rates are also negative, though the gap is much narrow compared to the US. So our sense is that hike we must. The pace and the quantum of rate hikes, can it be significantly muted or maybe a much lower band than the US? Well, our answer is yes. And the reason for that, as I mentioned, is that the resilience factor coming in from, if you look at the earnings growth, which is reflected in the company results, and of course, the pace at which the trajectory of inflation, which we are tracking. Fortunately for us, commodity prices, where we are predominantly price takers, has been on a slightly soft innings wicket, and that includes crude oil apart from gold. So that's also adding as a positive sentiment. So at this point in time, the only vulnerable piece, and of course the related effects, is actually the rupee, which obviously, against the force of the mammoth dollar, is kind of a little bit tepid. So aside of that, most of the parameters from a macro perspective right now seem to be in our favor.
Right. So with all of that said and done, would you say the Indian bond markets currently are facing more headwinds than tailwinds?
From a global perspective, definitely yes. And with the relentless rise of the US yields touching almost 4%, Indian bonds continue to be among the better performing dollar returns from a foreign investor standpoint also. In fact, the carnage that we have seen in US bond yields and, of course, some of the other developed market bond yields is significantly higher. So I would say, yes, it is a feel good factor, but for how long, given the fact that the news of, say, an index inclusion, which has been impending for a very long time, that could have been a very strong catalyst to anchor bond yields. That's visibly not there. Supply is going to continue for sure, but if there is no demand matching that commensurate supply, in the light of the fact that credit growth in the banking system is north of 16 to 17%. So I think those are the limited domestic factors which are posing as headwinds, but predominantly it is the global-led headwinds which are preventing any massive upside or downward bond movement in terms of yields.
Right. So I mean, I take your point on that front. Another factor that we've been talking about since quite some time now is the long-awaited global index inclusion. What's your sense on that front, firstly? And secondly, do you think the markets have now already started to price that in because it's really spoken about a lot? Or once the news, once we hear of it, it will be a sentimental positive?
Well, I would believe the latter because for some time up until, say, mid-September, there was reasonable euphoria with respect to the index inclusion news. It was in the realm of the known unknown, known in terms of inclusion, unknown in terms of timing. At the current juncture, it is kind of morphing itself into the unknown unknown. There were some sources yesterday also alluding to the fact that the timing might probably be next year. So that's adding to a little bit of confusion. So certainly if the news of that gets announced, say any time between now and say next month or so, it certainly is likely to be a sentiment positive.
Right. So taking that scenario into consideration and the way the yield curve is currently, right? What are the tenors from an investment perspective that could be a good bet?
Currently, if you see the shape of the yield curve, it's an absolute plateau. It's a flat yield curve. I'll give you an example. If you see a 2027 state loan index fund versus a 2032 state loan index fund, so the gap in maturity is 5 years. The gap in yield is just 5 to 6 basis points. So that clearly tells or suggests to you that on a risk-reward basis, being right in the center of the yield curve, which is that 4 to 7 year segment, seems to be a sweeter spot. And in terms of funds, if you are owning funds or securities or bonds, anywhere in the duration of 3 to 4 years, we believe on a risk-reward basis, given that they are pretty much at parity, allows you to cushion for any potential downside risk, and at the same time allows you to enjoy the carry and position yourself for potential capital gains as and when that news actually unfolds.
Right. So overall, in the current interest rate scenario as well, what are the factors we actually should be watching out for before making a good investment bet?
So watch out for incremental cues from the US. As I said, the past policy, they did 75 basis rate hike. So our sense, therefore, is that as we go into the policy tomorrow, the probability of 50 basis rate hike is only seemingly a sealed case. What is going to be the underlying guidance? That's going to be important. Also for the crude oil prices, while right now it seems to be a slightly friendly ally, when does it morph itself into a foe? It's something which we need to watch out for. And lastly, among the other commodities, look at food prices. Food prices in India have remained sticky and they continue to be a big driver of the inflation basket. So I think among other monitorables, I think these are going to be the key, apart from, and of course, therefore linked to it, therefore would be the central banker, decision making and the guidance thereof.
Right. And overall, if you see in terms of tenors as well, clearly you mentioned about risk reward already, but do you think this is a time, where you can make money out of bond deals in the current scenario?
Well, there are opportunities definitely unfolding across the yield curve, but at the same time, there is accompanied volatility as well. So it doesn't seem to be a slam dunk that the moment you put in money at the
Hmm.
10 year is currently at about 7.4%. It's not a given that the moment you put in money,
Hmm.
tic tac toe, you actually start making money in your favor.
Hmm.
That's not going to be the case. We have, as I said, quite a bit of these headwinds, which right now outweigh the tailwinds. So I think a staggered approach to investment in fixed income to be able to ride out this volatility, to my mind, could be a better way forward.
Hmm, right. And very lastly, Lakshmi, overall, if you have to see from an investment perspective, from an interest, inflation perspective and growth perspective, what's the sense you're picking up? Because yes, central banks are looking at inflation carefully. Two, they are squeezing out liquidity from the system. Interest rates are on an uptrend. So if you have to look at growth, inflation, and then what the interest rate hikes could be further in terms of domestic markets, what does that entire chain look like?
So as I mentioned, inflation right now doesn't seem to be a big evil. So the RBI forecast guidance well seems to be in that trajectory that we are right now. On the growth front, we believe there could be some small downward tweaks which we can see in the upcoming policy. And this is totally to mirror the global sentiment, where even IMF has downgraded global growth forecast. And from a policy making stance, therefore, you need to try to find that right balance, which probably at this juncture, as I said, expectation of 5.8 on the inflation front in the fourth quarter of FY 2023 means our policy rates should at least be at 5.9 or 6%. Now, tomorrow, are we going to see 50 or 60? I don't really have a science to show you how to prove that, but I think 5.9 to 6 could be the repo rate for now, and then incrementally how much more global factors unravel. That means another maybe 25 to 40 basis points of incremental rate hike probably could be in store in the December policy. So six quarters. So we had a view here that the policy rates could pause at around 5.9 to 6%. If things continue to be fluid, then RBI might need to be more agile and have that, I would say, an insurance rate hike to ensure that things don't go completely down under. So I think six-ish for now is what we would run with, maybe with an outer chance of 25 to 40 basis in the policy after that.
Right. So overall, I mean, there are a lot of factors which actually tell you, Lakshmi, that it is a wait and watch kind of a mode right now. You can't 100% plunge into it, but there are factors you can watch for and take baby steps towards achieving your target.
Absolutely. Baby steps is the word, but invest you must. Sitting on the fence and trying to wait it out may not be the best way forward.
Absolutely. Thank you, Lakshmi. Thank you so much for joining us on the show. It's always a pleasure to speak to you, get insights from you. Thank you. Stay safe and speak to you soon again.
Thank you. Bye. See you.
Bye.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.